Assalamualaikum warahmatullahi wabarakatuh. We are Group 3 from class KMA1. Our group will be presenting on Sukuk versus conventional bonds, structure, risk and market transaction. This presentation will explain the key differences and similarities between these two financial instruments, risk and return analysis, Malaysian market overview and global trends of Sukuk and also bonds. I will begin by giving a short overview of Sukuk and conventional bonds and their main purpose. Conventional bonds and Sukuk are both used to provide long-term financing for governments and corporations. Conventional bonds are debt-based instruments that offer fixed interest rates and are generally associated with higher risk perception. In contrast, Sukuk are Sharia compliant, meaning they do not involve interest and are based on asset ownership and risk sharing, which makes them less volatile and more stabilizing during periods of financial stress. Although both instruments are used for financing and share similar contractual characteristics, this presentation compares their structure, risk and return, and performance in the global and Malaysian markets.
Sukuk versus bond, which more than just a name. You see them both in the financial pages, Sukuk and bonds, and they both raise capital and they both offer returns. So are they basically the same thing, and which is not even close. Let's break down why their structure makes them worlds apart. Firstly, we can see that it starts with a simple question: what are you buying? With conventional bond, you are buying a promise, lend cash, and you are promised your money back plus interest. You are a lender. With a Sukuk, you are buying a piece of something real, which a share of building, an airport, a business venture, and you are a part owner. Your profit comes from what that asset returns, and which is not from a fixed interest rate. And one is booked on debt, while the other is booked on ownership. Which this create two completely different risk model. With a bond, risk is transfer. You get your fixed coupon no matter what. The business risk stay with the company, and it's a one-way financial risk. While with a Sukuk, this is shared. If the asset does well, you profit more. If it struggle, you return it. You are in it together. To make this ownership work legally, Sukuk use a special legal entity and SPV to hold the asset for all the investors, which it is a structural requirement that bonds don't have. So does this theoretical different extreme matter? Absolutely. Recent research show it's play out in the market. For example, studies find that strong ESG can share lower financial costs for Sukuk more than for bond. Why? Because ethics are built into Sukuk's DNA. They are already screened out harmful industry. They also behave differently during economic swing, which their asset backing can provide a cushion, making them less twitchy than pure debt instrument during volatility. Now, it's true that some asset-based Sukuk have guarantees that make them feel safer like a bond, but even there, the core requirement, a real asset and Sharia compliant contract remains. That's a structural line in the sand. So the next time you hear Sukuk and bond, remember it's not just a different label. It's a choice between two financial philosophies. One is the established part of credit and fixed income. The other is the growing paradigm of asset-based ethical participation.
Assalamualaikum, my name is Naizazati binti Isha, 1230840. I will talk about risk and return analysis. For the risk and return analysis, Sukuk and bonds, first they have risk source, which is Sukuk risk is from asset or Sharia compliance, and bond risk is from credit or interest rate. Second one is return and volatility, which is yields are often similar, but Sukuk typically have lower price volatility and better downside protection. Third one is market signal. Stock market react more positively to Sukuk issuance, seeing it as a stronger, more ethical financial signal than bonds. And the last one is ESG advantage, which is Sukuk's inherent ethical focus may lower its cost yield as demand for sustainable asset grow. That's all from me.
I will be
discussing the Malaysian market overview of Sukuk and conventional bonds, focusing on market structure, size, performance, and key challenges. Malaysia is well known for having a dual-type capital market where both Sharia-compliant Sukuk and conventional bonds coexist under a strong regulatory framework by the Security Commission Malaysia. Referring to the pie chart on this slide, we can see that Sukuk dominates Malaysia's type capital market. In 2023, Sukuk accounted for about 60.8% of total bond and Sukuk issuance, while conventional bonds represented only 39.2%. This dominance reflects strong domestic demand for Sukuk, particularly from Islamic bank, takaful operators, and institutional investors that prioritize Sharia compliance and long-term stability. At the same time, conventional bonds remain important, especially for investors who prefer higher liquidity and active secondary market trading. In terms of performance, Sukuk are generally viewed as more stable and less volatile due to their Sharia-compliant and asset-backed structure. Many investors adopt a buy and hold strategy which supports market stability. However, studies such as SITE 2021 highlight that this behavior also leads to lower secondary market liquidity. On the other hand, conventional bonds are more sensitive to interest rate change, resulting in higher yield volatility. Despite this, their active trading environment allows investors to adjust portfolio more easily and potentially achieve higher short to medium-term return. Although Sukuk dominates the market, several challenges remain. These include limited liquidity, issuer concentration, mainly among government-linked entities, and different in Sharia interpretation that may affect cross-border investment. Meanwhile, conventional bonds face higher exposure to macroeconomic and interest rate risks, but they help improve overall market flexibility and depth. In conclusion, Sukuk and conventional bond complement each other in Malaysia's debt capital market. Sukuk provides stability and Sharia compliance, while conventional bonds enhance liquidity and trading efficiency, contributing to a more resilient and balanced capital market. That's all.
Next, we move to the global trends of Sukuk and bonds. The global financial system is shifting towards sustainability. Conventional bonds have limitations in certain markets, while Sukuk offer a Sharia-compliant and ethical alternative. Green bonds and green Sukuk play an important role in financing environmentally friendly projects and supporting sustainability development. First is green Sukuk. The first point is green Sukuk is Sharia compliant and asset-backed. Green Sukuk follows Sharia principle and is supported by real underlying assets. This means the financing is linked to actual project rather than interest-based lending. So is funds are used for halal and environmentally friendly projects. The funds raised through green Sukuk are used to finance halal and environmentally friendly projects such as renewable energy and environmental protection initiatives. This green Sukuk attract both Islamic and green investors. Green Sukuk appeals to Islamic investors who seek Sharia compliant and to green investors who focus on sustainability is green bond. So for the first point is green bonds are debt-based fixed income instrument. Green bonds are debt instruments where investors lend money to the issuer and receive fixed interest payments. So is funds are used to finance environmentally friendly projects. The proceeds from green bonds are allocated to environmentally friendly projects, including clean energy and low carbon infrastructure. Number 3 is green bond issuance can improve firm value and stock performance. Issuing green bonds can enhance a company reputation, attract more investors, and potentially improve firm value and stock market performance.
In conclusion, both Sukuk and conventional bonds play an important role in raising long-term capital, but they follow different financial principles. Conventional bonds are debt-based with fixed interest, while Sukuk are asset-based and involve risk-sharing under Sharia. Due to this structure, Sukuk tend to be less volatile and more stabilizing, and investors generally view them more positively. In Malaysia, the coexistence of Sukuk and conventional bonds strengthens market depth, resilience, and long-term capital market growth. For recommendation, policymakers should promote balanced growth of Sukuk and conventional bonds by improving liquidity, transparency and standardization. Issuers are encouraged to use Sukuk for long-term, asset-intensive and sustainable projects including green and SRI Sukuk. Investors can enhance portfolio stability by treating Sukuk as a separate asset class alongside traditional bonds. Future research should examine Sukuk performance across economic cycles and the role of ESG in pricing and investor behavior.